We'll go next to Steve Shearer from Thomson Reuters, please.
Good morning, Governor. Thank you. Can you hear me?
Yeah.
Yes.
In your forecast for inflation today, you say you forecast that it'll be declining to 3% by mid-year and then 2% next year. Since 3% is sort of the upper band of your target, does that mean once you get to 3%, you can start considering cutting, and money markets are pricing in a cut by October?
Well, look, today we've announced that we're raising, and we think it's time for a pause. But let's keep in mind that inflation's still over 6%, and yes, we are certainly seeing clear evidence, and that has reinforced our confidence that inflation's coming down. But look, we do have to be humble. There are a number of risks out there, which we've outlined in the monetary policy report. So it's really far too early to be talking about cuts. The pause really is designed to give us time to assess whether we've raised interest rates enough to get inflation all the way back to target. And I would also just emphasize that the 1% to 3% band is not a zone of indifference. It's designed to give a sense of where Canadians can normally expect fluctuations in inflation. And if you want to be within the 1% to 3% band most of the time, you need to aim for the middle of the band. So our objective is to bring inflation all the way back to 2%.
Thank you. We'll turn now to market news and Greg Quinn.
Good morning. I wanted to ask about the confidence in the view of inflation is solidly, significantly coming down. Last year, officials expressed some doubts about your ability to forecast inflation. You abandoned a measure of core inflation that proved to be a little bit wonky. In particular, the view that inflation is of 2%, the target is within sight now. That also seems a contrast with your own survey of consumer expectations, which show a much higher view of prices over that time frame. So where is this confidence coming from that inflation is getting back under control?
Greg, look, I don't want to minimize the risks, and I'll come back to that. But let me start with there are a number of things that are giving us some confidence or reinforcing our confidence that inflation will come down. First is we are seeing evidence that the considerable and rapid interest rate increases that we have put in place are working. You can see clear evidence of slowing in more interest-sensitive parts of the economy, and you can see the rates of inflation on those goods have come down. Secondly, we have had some more favorable developments with global supply chains. Those disruptions are resolving, and in fact, relative to October, they've resolved a little faster than we were expecting. Inflation has come down, and if you look at the 3 month you look at shorter term measures of inflation, 3 month moving average, for example, you can see that the momentum in inflation is cooling. And finally, look, we raised our policy rate 25 basis points today, so we've now got a cumulative increase of 425 basis points. Monetary policy is in restrictive territory, and we know monetary policy works with a lag. And as the effects of those higher interest rates work through the economy, we do expect to see a more generalized slowing in prices. So these developments have reinforced our confidence, but yes, as I said to a previous question, look, we do need to be humble. We are living in a very uncertain world. There's a continued war in Europe. China is reopening rapidly. That could certainly create some upside risks to global commodity prices. Oil prices could go back up. That would boost global inflation. So, as I said in my opening statement, we think it's time to pause, but that is a conditional pause. And we are going to be watching carefully to see if economic developments come out in line with the forecast we put out today.
As the bank now shifts to a different stage where it's pausing its rate hikes, what communication challenges do you see ahead for the Bank of Canada when it comes to communicating with Canadians about its role in the economy?
Well, I think the a few key things here. First of all, 6% inflation is better than 8% inflation, but 6% inflation is still way too high. And Canadians are still feeling the pain of rapid increases in the cost of living. Economic developments have reinforced our confidence that inflation is coming down, but it's going to take us a while to get there, and the economy is going to be soft. I mean, we think growth is going to stall. So this is going to be a tough adjustment. I think the key message is it's working. We do think that the momentum in inflation has shifted. Inflation is coming down. And as we get through that, as we get inflation back down to our target, Canadians can enjoy the benefits of being confident that inflation will be low, stable, and predictable, and we can resume to positive growth. But I don't want to diminish the adjustment that we have to go through to get there. It's going to be worth it. It's working, but there is an adjustment.
Alicia from Yahoo Finance, if you can unmute by pressing *6.
Okay, thank you for giving me another shot here. Governor Macklem, what's your message to Canadians who are still feeling the impact of high inflation with higher debt costs and grocery prices remaining stubbornly high? How do you want them to think about this conditional pause?
Well, I think the message to Canadians, first of all, is that we know inflation's still too high, and we know that's affecting Canadians. We're acutely aware that low-income Canadians are disproportionately affected by this high inflation. They don't have extra savings to buffer the price increases, and some of the largest price increases have been in essentials, in groceries. Food prices are still going up 11%. Rent is rising. Rent is increasing. These are essentials. These are not things that you can cut back on. So we're acutely aware that Canadians are feeling that. I think our second message is the Bank of Canada has done a lot. We've raised rates now 425 basis points on a cumulative basis over the last year. That is putting an increased burden on Canadians that have high debt loads. That is stretching them. But what we see is that, as these interest rate increases are working through the economy, they are working to rebalance demand. Inflation is coming down. And yes, we're going to have a period of virtually no growth for the next few quarters. But as inflation comes down, the growth will be restored, and it's going to be worth it.